Have you ever wondered why some businesses prosper while others fail? A survey found that just 20% of startup businesses survive their first 5 years of operation. Let's consider the following scenario. Company A and Company B are both phone manufacturers. Both companies began operations in the same year and had an annual revenue of $10 million in their first year. 5 years later, firm A falls bankrupt and ceases to exist, whereas Company B has expanded to generate hundreds of millions of dollars in yearly revenue. What transpired and what made the difference between these two companies can be found in their cash flow statements. In simple terms, cash flow is the movement of cash into or out of a business or enterprise. It represents the entire amount of money that enters and exits a business. When we talk about money, we don't just mean cash, we also mean cash equivalents. For example, things like office buildings, machinery, warehouses, plants, trucks, and so on that come and go aren't cash, but they are cash equivalents. At the most basic level, if a company can generate profit for its shareholders and build a structure that guarantees positive returns for many years to come, it means that the company's cash flow isn't in good shape. On the other hand, if the company is struggling to pay dividends to shareholders and is losing earnings, it indicates that the company's cash flow is in poor health. Positive cash flow can be categorized into two types. Positive cash flow indicates that a company is increasing its cash reserves, which means that it is making more money than it is spending. This type of result may allow the company to reinvest in the company, pay dividends to shareholders, and handle future payments to the deceased. Let's say the company's total revenue for the year is $100 million, but its total spending is $60 million, which means the company has $40 million in excess. This $40 million will be paid out to shareholders in the form of dividends, and a portion of the profit could also be used to acquire equipment and other forms of investments that could sustain the company's long-term growth and earnings. Negative cash flow occurs when a company spends more money than it generates. This situation can affect businesses differently, even within the same industry. For instance, let's look at two companies, Diamond Brand and Emerald. Diamond Brand generates $200 million in revenue in a year, but has total expenditures of $220 million. This means Diamond Brand is operating with a negative cash flow, having accumulated $20 million in losses. On the other hand, Emerald, another company in the same industry, earns $150 million in revenue, but only spends $100 million. This results in a positive cash flow, with Emerald making a net gain of $50 million. In summary, even if one company generates more revenue than another, it can still experience negative cash flow if its expenses exceed its income, whereas a company with lower revenue but controlled spending can maintain a positive cash flow. In this scenario, despite Diamond Brand generating more sales and revenue, Emerald is far ahead in profit and sustainability. At this rate, Diamond Brand is likely to close down in a few years, while Emerald could be on its way to becoming the next big success story. If you're finding value in this video, please pause it now and hit the like button. Also, click on subscribe so you can be notified of more inspiring videos, just like this one. Done? Awesome. Let's continue. The Cash Flow Statement, CFS, is a crucial financial document that presents the inflow and outflow of cash and cash equivalents within a company. It provides a clear picture of how a company manages its cash situation, detailing how money is generated and used to meet financial obligations. This statement is essential as it helps stakeholders understand the company's ability to generate cash to fund operating expenses, pay debts, and invest in growth. The CFS is a mandatory part of a company's financial reports, offering valuable insights into the company's liquidity and overall financial health. Here are different forms of cash flow. Operational cash flow. This includes all the money that comes from a company's core business activities. For example, if you own a furniture manufacturing company, all the cash generated from the manufacturing and distribution processes falls under this category. This incoming cash is used to pay salaries, cover operational costs, and meet other business expenses. Workers use their earnings to meet personal financial obligations, and you, As the business owner, handle your personal financial needs from the money you earn. Operational cash flow is crucial, as it reflects the company's ability to generate sufficient revenue from its primary activities to sustain its operations and invest in future growth. It indicates the health of the core business functions and is a key indicator of financial stability and performance. Investment cash flow. This refers to cash generated or spent on a company's investing activities. It includes investments in other businesses, purchases, or sales of capital assets such as plants or equipment. These investments are typically made for the expansion of the company. Successful investments can lead to higher dividends for shareholders and an increase in the company's overall value. For example, if you invest in new machinery or additional facilities for your furniture company, this could significantly increase your production capacity and consequently your net worth. These investments reflect the company's long-term growth strategy and its ability to generate future income from acquired assets. Financing cash flow. This includes cash a company receives through debts owed by other entities or cash paid out as debt repayment. It encompasses the money involved when issuing bonds, selling stocks, or repaying loans. If a business falls short on cash and cannot meet its obligations, it will experience a cash flow crunch. Prolonged cash flow crunches can lead to bankruptcy, which is detrimental to any establishment. Therefore, it is advisable to set up an emergency fund, setting aside money during good times to manage future emergencies. This strategy is beneficial for managing cash flow, both personally and for your business. Free cash flow. While not one of the three major types of cash flow, free cash flow is highly valued by investors. It is calculated by subtracting capital expenditures from operational cash flows. Free cash flow represents the money available after a company has met all its obligations. It is crucial because it indicates the funds a company has at its disposal for expansion, dividends, or other purposes. Business analysts often use this measure to assess a company's profitability. Robert Kiyosaki, the author of the best-selling book Rich Dad, Poor Dad, explains cash flow through his concept called the Cash Flow Quadrant. According to Kiyosaki, people fall into one of four categories. 1. Employees, those who work for others and earn a salary. 2. Small business owners / self-employed, individuals who run their own businesses or are specialists like doctors or lawyers. 3. Big business owners, those who own large businesses and systems that generate revenue. 4. Investors, individuals who invest money to create more wealth. Kiyosaki shares his personal story to illustrate these concepts. Through the Cash Flow Quadrant, Kiyosaki illustrates that financial success and independence come from moving from the left side, employees and self-employed, to the right side, big business owners and investors of the quadrant. A big business owner is someone who builds a business with up to 500 employees. An investor, on the other hand, transitions from owning businesses to investing in other businesses. Investors do not participate in the day-to-day operations of the companies they invest in, but make money from their investments. Examples of big business owners include Mark Zuckerberg, Elon Musk, Bill Gates, and Michael Dell. These individuals legally pay the lowest taxes, resulting in a more unhindered cash flow and greater opportunities to grow their wealth. People in the first two categories, employees and specialists, pay the highest taxes and may struggle financially if their responsibilities increase. To build wealth, transitioning from an employee specialist to a big business owner and investor is crucial. While being an employee or specialist can be a good starting point, aiming for higher financial goals is important. Saving money from earnings in the first two categories can be invested in assets to generate passive income. Kiyosaki defines assets as anything that brings you money, while liabilities take money away. For example, homes and cars are often considered assets, but can be liabilities if they drain your cash flow. To build positive cash flow, focus on investments that generate passive income, such as real estate. For instance, if you purchase an apartment building for $1 million financed by the bank, generating $15,000 in monthly revenue with $12,000 in expenses, you would have $3,000 in positive cash flow each month. This passive income can contribute to financial freedom and wealth building. Kiyosaki suggests keeping liabilities low while growing assets to achieve positive cash flow and financial independence. Investing in assets that generate passive income is key to building wealth. Thanks for watching. If you appreciated and found this video useful, please give it a thumbs up. If you are new to the channel, welcome. Consider subscribing to receive more videos like this. Have a wonderful day, and I will see you in the next one.